Well, hello and welcome back to the Wealth Alchemist. Kevin Dick here today, CEO over at KDI Wealth, and I'm actually joined by someone who's become a real, let's see, what would I would say a great educator for our team in the subject of alternatives. I'm here with Steve Pointer today, and Steve is actually based out of San Diego, not Scottsdale, so similar weather, but you got an ocean. You know, a little flex power there. But we're both sitting in great weather. I think you're in Orange County today, but that's not roughing it either. Um, but Steve comes to us. He's with Cantor Fitzgerald, and he's one of the area directors, which means he knows enough to help us do great due diligence on behalf of our clients. And I'm just really appreciative of you taking the time today, Steve, to kind of fill us in a little bit more about alternatives.
Excited to be here. Thanks for having me, Kevin.
You bet. And what would you say if I asked you today, just kind of off the cuff, when people talk about alternatives in our business, it's kind of become a buzzword now. It's like, oh, do you have alternatives in your portfolio? Do you have alt? And we throw these, we're the masters of using jargon, right, in our industry. So when we say that, when you guys are talking about alternatives, and again, this is one of your areas of expertise, what does that mean?
Great question, Kevin. And I think that it holds true for most retail investors is they're familiar with us investing their assets in traditional stocks, bonds, and cash. And
Right?
I define alternatives as any investment outside of that, albeit real estate, private equity, private credit, infrastructure, all of the above.
That's that it actually probably covers a lot more than what we talk about normally. Is that accurate?
Correct. Yes, it is very broad brush.
Generally, when we talk about alternatives, most clients don't have an entire portfolio of alternatives. Alternatives typically play a role. We would call it a sleeve. Basically, it's a percentage of assets, perhaps. When you think about alternatives, how do they compare with traditional investments like stocks and bonds in terms of risk?
Everybody has their own definition of how alternatives benefit a client's portfolio. When I think about it in terms of risk, I think that alternative investments have historically delivered non-correlation to some of those traditional asset classes that I mentioned. And that non-correlation tends to provide more stability. And it also has historically provided very stable income, at times tax benefits, as well as greater alpha to the portfolio.
So basically, when traditional investments are you might even liken it to when they're going down, alternatives may be stable, and when alternatives are having their bad day, they might be stocks might be going up. So they tend to even the line. Is that accurate?
Correct. Yes. Said differently, alternative investments have at times lower economic sensitivity and sometimes lower interest rate sensitivity, depending on the respective sub asset class.
How does that get accomplished? Like what do you think is the secret sauce that makes that happen?
Well, if you think about something like real estate is not historically priced on a daily basis like you would see in a publicly traded stock, mutual fund, or exchange traded fund. So by that very nature, private real estate provides more stability to the portfolio. And in most cases, with real estate, the primary goal is receiving rents, of which are then passed through to investors. And if you look at the benefit of owning real estate, even on its own, investors get to depreciate the property. And when they invest in a real estate investment, oftentimes they participate in that same tax benefit. So all of the cash flow that's getting paid out to investors is often tax advantaged as well, which just boosts the overall value delivered to an investor's portfolio over time.
So when you say tax advantage, probably, the assets being depreciated while the income's going out, and so those two pair against each other, that kind of thing?
Correct. Yes. So if you're receiving, call it a 5% distribution from a real estate investment, and you're getting 50 to 100% what's called return of capital or depreciation that shows up on the 1099, at the highest tax bracket, that could be 6.5, 7% as a tax equivalent yield, which is really powerful, especially in times like we're looking at right now in a time where interest rates are expected to go down over the coming years, because that makes it even more attractive relative to owning cash.
I would love for interest rates to go down a little bit more.
Wouldn't we all?
It's it's really easy to get caught up in the whirlwind if you don't know your goals and your expectations and what you need your portfolio to do, rather than measuring against everybody else.
I mean, everybody's situation is different. And that's why there's financial advisors like yourself who are there to weigh a client's goals against their risks and time horizon, and how some of these investments play into those goals and objectives.
I don't know that there are too many industries that evolve and change as much as ours, and really we're in our infancy compared to like attorneys and tax people. Our industry just continues to evolve. You know, we were financial advisors, and then we were stockbrokers, then financial advisors, and now there's wealth managers, and I mean, I tried to think of all the different names we call ourselves, but I'm curious, how have alternatives evolved, let's say in the last 5 to 10 years?
Alternatives have grown in a very big way. I think historically, uh, financial advisors and even clients have had hundreds of different ways that they can access alternative asset classes via public markets. As I mentioned earlier, whether that's individual stocks of companies that may be classified as alternative asset classes, or whether it's a basket of securities in a mutual fund or an exchange traded fund, that has been the norm. Now, over the last decade, there has been a democratization of alternative investments, meaning that there are more vehicles out there to provide the average investor with access to these private investments, which may behave more similarly to the underlying asset class. What I mean by that is that anybody can go out to their Schwab or Fidelity account and buy a publicly traded real estate investment trust. But not everybody can access a private real estate investment trust and actually gain access to a portfolio of high quality commercial real estate that has a different set of pros and cons relative to the publicly traded counterparts. So if you look back at private infrastructure 10 years ago, infrastructure assets under management, there was only about 200 billion. Fast forward to today, it's about 1.5 trillion, which is on par with real estate assets under management. And private credit, to put it in perspective, is at $2 trillion. So we believe that given that trajectory of infrastructure as an asset class, we expect that infrastructure will overtake both real estate and private credit as the largest alternative asset class in private markets within the next 12 to 18 months.
That's amazing. And why is that? Why is that drive towards infrastructure?
I think you really have a confluence of events. So infrastructure defined is really the physical assets that drive our economy and allows us to improve our daily lives. So historically, people have thought about infrastructure as just being roads and bridges, which is true, but we're more focused on modern forms of infrastructure, or what we often refer to as mega trends that we're seeing in the infrastructure world. And those are, number one, is going to be digital infrastructure. Digital infrastructure is cell towers, data centers, fiber to the home, for example. The second mega trend is energy transition. So anything related to lower costs, more renewable forms of infrastructure, such as hydrogen and nuclear, and to another extent would be wind and solar. And then the last phase or mega trend is referred to as the enhancement of aging infrastructure. And the enhancement of aging infrastructure has a lot to do with what you hear about on the news every day. You hear about trains getting derailed, bridges collapsing, highways deteriorating. And if you weren't aware, most of the US infrastructure was put in place here in the United States post World War II. And we have simply underspent from a government funding perspective. And now in recent years, you have legislation like the Infrastructure and Jobs Act, the IIJA in 2021. And then you had the Inflation Reduction Act, the IRA, that came along in 2022. Those are great initial steps forward. But even if that all of that funding were to have actually been allocated, it would only account for about one of the $2.6 trillion that we estimate that needs to be spent on infrastructure just to bring it up to speed with today's demand. So, matter of fact, that $1 trillion between those two pieces of legislation, only about 7% has actually been spent so far.
That's crazy.
And here we are 3 to 4 years later.
So has it been allocated already, or is it not? Have our municipalities not coming to get it, or what's going on there?
That's a big question for somebody up on Capitol Hill.
You and I were talking not long ago, I think it's been a couple weeks now, and you were explaining how important it is for some of these digital companies now. They're kind of going to be responsible for their own power for some of these servers and things. Can you talk about that a little bit?
Yeah, so we recently heard about 3 weeks ago, there was the announcement of Project Stargate. And Stargate is a joint venture with OpenAI and two other firms, which there will be $500 billion put to work in 20 data centers across the country. $100 billion of that is already in motion in a data center that's being built in Texas, and the other 19 data centers will be started in the years to come. But a lot of that is just a demonstration of the growth of AI. It's explosive in terms of how many companies are popping up, and how much capital is being allocated, because all of the artificial intelligence, all of that data that's being generated from it, all has to go to a data center and to a cell tower. So that is leading to more data centers being built, and all of those data centers then need the utility infrastructure, energy to then support them. So that's leading to more investment in the asset class, which has some overlap with real estate, right? It is a physical asset, but it also has a lot to do with infrastructure and the number of devices out there in the world, right? How many of us have 3 devices, a cell phone, a tablet, and a computer? Again, that's every keystroke is then transmitting more and more data, leading to more data centers and more need for energy infrastructure.
I think that's going to be a really interesting space to watch. There's a couple of things that you brought up in that I get really excited about. One is, in that data storage and those data drivers, those centers. I mean, we're seeing more and more around the genome type storage and types of storage that's not going to rely on heat and air. It's going to be able to be non-temperature controlled, which will save some energy. And all these things that not only speak to the data getting better, but getting faster, which means things get done quicker and AI can think through processes and systems faster. It's just amazing to watch.
Couldn't agree more.
I'm actually really excited about where we're going and the opportunities ahead of us. When you're talking to folks and I know you get the opportunity to you're typically talking to advisors. So for the most part, kind of peer-to-peer, or you've got obviously an edge on us in your space, and you're helping us understand your space better. And then sometimes you're talking to a room full of clients, probably on behalf of advisors, and helping them understand too why they may or may not want alternatives. What are some of the different risks that people should consider, when they look at an alternative type investment? The first one came to mind for me when you said, you can go get it public on an EFT or ETF. EFT is when we send you money. ETF, electronically traded fund, or you can go get a private. I know when you're out there in a fund, you're sharing all the risk. That's why they call them mutual funds, because it's mutual share of taxes, of capital gains. Even if you didn't sell, you might get a capital gains check. But certainly there's got to be some types of risk in holding privately held or let's say quarterly liquid. What are some, and I don't expect you to do a whole diatribe by any means, a legal diatribe of everything. We always know there's more and each investment should be considered, but just in general, how do you look at risk when you're looking at alternatives?
Great question. So I learned early in my career to keep things simple. And when I think about risk, I like to separate it into three main categories. And those categories are sponsor, strategy, and structure. So, first off, you have to look at the quality of the sponsor. What is their track record? What is their access to deals in that respective asset class? Have they historically worked with institutional investors or retail investors? Their overall corporate governance and compliance. Those are all things that go into the strength of the sponsor. Number two is the strategy, kind of what we spoke about earlier. Are they focused on real estate, private credit, private equity, infrastructure, maybe oil and gas? There's a lot of different broadly defined alternative investments, or it could be a culmination of all of them, often referred to as real assets. The last segment of risk that I think about is structure. So, when you look at a real estate investment, there's hundreds of different ways to invest in real estate, even in private markets, whether it be a private placement, a real estate investment trust, a 40 Act interval fund structure. Those are kind of the key structures that give an average investor access to real estate or some of the other food groups we talked about. But those are all areas that have to be thoroughly thought through. And I would say, the structure is often going to lead to more or less liquidity, right? There's some private equity alternatives where it's a minimum 10-year commitment. And there's other structures that may have monthly or quarterly liquidity. So it's really the investment risk is bared on the financial advisor who is allocating the investor and their level of comfort and time horizon.
To take such a broad topic, I think you did an excellent job of summarizing that. Yeah, it's deep and wide. I'm kind of curious, and I think our clients might be curious, and other listeners if they happen to jump on. When we talk about a 10-year hold on private equity, why is that? Like, why do they need 10 years to turn that around? And do they typically go 10 years, or do they typically? I'm not saying across the board, but just in general speaking, is the 10 years so that they have time to like cultivate it?
So there's an evolution behind the private equity model. So there's often the phase of where you're raising capital. And then once the capital is raised, it then needs to then source the investment or pool of investments. And then once the assets are acquired, they need to execute a business plan. And then they manage the asset. And then they look to then create liquidity via a sale or public listing. So that typically takes time. And historically, that's been on a minimum 5 years and upwards of 10 plus years.
And so what you just told me again, in different terms, is again the importance of that sponsor, because somebody that's got a track record, that goes back 30, 40 years or more and has put these deals together and has some consistency in how things go versus somebody that says, hey, I think I'm going to open a private equity position. I'm going to take this, I'm going to take this out to qualified investors next week, and it's their first time. I mean, it does matter, and certainly we're going to vet the sponsor, and it would be a great idea for the clients to do the same. I have one follow-up question, then I want to give you just a couple minutes if there's anything that you want to add that you feel like we should have touched on about alternatives that we didn't. But when um, when we talk about, some certainly there are private equity deals that have not gone well. Again, um, not every investment goes well. There's quarterly liquids that, don't perform from time to time. But when when we look generally at the risk reward, should people expect a little better return from something to a comparable investment if they're locking it up for a certain amount of time? Or should they expect, market average returns compared to typical investments, non-alternative, let's say?
I think you have to come back to the strategy and the expectations that are set by the sponsor. So there are strategies that are often referred to as super core or a core strategy, which typically means a lower risk, lower return profile. And then you get into value add or opportunistic strategies, which take on a little bit more risk and hence would then set the expectation of a potential for higher returns. That doesn't always actually get executed upon. To your point, there's what's called a illiquidity premium that the industry has historically referred to. And by taking that risk of not being able to churn your investment into cash within the same day, week, month, or even year, that should ultimately lead to a better return. And that is the hope, but not always the outcome.
Sure, sure. Wow. I mean, I'm excited about, I certainly appreciate your and my relationship and some of the tools and strategies you've brought to us. I'm excited to see where this goes in terms of the evolution of alternatives. I think I've still got, I don't know, 15, 20 years left in me. I'm 55. I've only been in it 27 years, so I got a little bit of time ahead of me. Is there anything regarding alternatives, risk, return, thoughts, anything else that you think we should share before we wrap this up today?
Absolutely. I think, so far we've kept the conversation relating to how you access alternatives within your investment portfolio, but that's not always the case. There's alternatives out there that can help a client solve for a taxable event.
Yeah.
So many investors are often familiar with what's called a 1031 exchange, which has been in the tax
Sure.
code for over 100 years. It was put in place in 1921. And that simply says that you can sell one property and exchange into another property within a specific period of time and some additional hoops to jump through. And
Right.
by going through that exchange process, the IRS says that if you follow all the rules, then you can defer the tax on the sale of highly appreciated investment property, essentially anything other than a primary residence. And so a lot of investors out there think that 1031 exchange only applies to them going out and exchanging into a property that they have to actively manage themselves. But in the last, call it 2 decades, there's been a proliferation of a vehicle called a Delaware Statutory Trust, which was put in the tax code under Revenue Code 2004 86 and qualifies for replacement purposes under Section 1031 exchange. So it allows for an investor to acquire fractionalized ownership of this type of trust that holds commercial property. Therefore, it satisfies their exchange. And by exchanging into a Delaware statutory trust, we, as the sponsor, execute a business plan, and all of the cash flow from that property is then passed through to investors, net of expenses. And they also get to participate in all of the upside of that property in proportion to their ownership percentage until we, as the sponsor, decide to sell that property. And then they would start from square one. When we sell the property, they can cash out and pay the tax. They can exchange into another trust, or they can go out and exchange into another property if they wanted to. So it's a nice way for investors who have done very well in real estate that are looking to sell and not want to go back into active management to then have a passive investment.
Nobody's
And
going to call
so,
them to fix the toilet or to change out the air conditioner on the roof of the 10,000 square foot corporate building.
correct. Yes, we often refer to those as the three T's: toilets, tenants, and trash.
No more
There,
phone calls.
exactly. There's one additional investment I think is worth bringing to you and your listeners' attention, and that's the Opportunity Zone program. And the Opportunity Zone program, I think, is often overlooked. It was created in the 2017 Tax Cuts and Jobs Act as bipartisan legislation with the goal of spurring long-term economic growth in these areas that were essentially underserved based on economic data in the 2010 census. So I like to always clarify that not all opportunity zones are created equal. A lot of people rush to think that these areas are on the wrong side of town or areas you wouldn't want to walk down at night. But there's areas like the Oakland waterfront, the Arts District of Los Angeles and North Hollywood, Old Town Scottsdale, most of downtown Tucson, SoFi Stadium when the Rams and the Chargers play, the entire Houston Medical District. Apple built their second headquarters in Austin, Texas, inside of an opportunity zone. So there's over 8,700 of these zones throughout the country. It makes up about 18% of the US landmass. So what I'm getting at is these opportunity zones were created in 2017, and the program was widely adopted in 2019 after the IRS rolled out 3 rounds of regulations. And that's really where the bulk of the investment began, was late 2019. And since then, based on recent reports, there's been about $80 billion invested in these opportunity zones. And that's only the zones that have actually, or sorry, that's only the funds that have actually reported. So we believe it's well beyond $100 billion that has been invested in these areas. And arguably, if the legislation wasn't around, they may not have seen those dollars pour in. So it's doing everything it was intended to do. And then how it relates to you and your listeners is that if your listeners had or were planning to sell a business or a investment property or primary residence or a concentrated stock position, they could sell that appreciated asset, take the cost basis, put that in their pocket tax free, and only reinvest the capital gain within 180 days. And by reinvesting that gain into a qualified opportunity zone fund, they at this point defer the tax until December 31st of 2026. So they get a tax bill on their original gain in 2027, but any growth on that original amount that they put in, once they've held the investment for 10 years or more, it's 100% tax free. So this has been regarded as one of the most lucrative tax benefits as it relates to real estate since Section 1031 was created over 100 years ago.
And I know folks listening are going to say, well, this sounds like, some kind of magic, or I'd be playing in an area that this is a risky strategy. It's not that at all, correct?
There is always risk.
Well, I don't mean the investment
any
itself. I'm talking
investment.
about let me talk about the tax
The
implications.
legislation.
Yeah, you're not playing in the dark side of taxes. This is legit. It's on the up and up.
Correct. This is actually written in the tax code. This is legislation that was passed under the 2017 TCJA. And coming back to my point of the amount of impact that the program has made, there's been a lot of talks leading up to the end of this year as they look to extend the Tax Cuts and Jobs Act. And we expect that the Opportunity Zone program has a good likelihood of getting extended. And what they are considering is an extension of the deferral from the end of 2026 to December 31st of 2028, meaning no tax would be due on an initial gain until 2029. And then the original benefit will still stand, that once you've held the investment for 10 years, any growth is then 100% tax free.
Yeah, that's pretty cool. I know that anytime we're looking at really sophisticated type investing where we're going down a road like this, we would include somebody like yourself on the call. We'd always get, the person's tax professional involved and make sure that everybody agrees and just make sure that, it goes back to what we always say, it's a team approach in managing wealth. You want the whole team in the room. But these types of strategies, the average person, and when I say average, people think I'm saying people with not a lot of money. That's not what I'm saying. There's a lot of very wealthy people who are average in their knowledge of what all is out there and what opportunities, both tax wise as well as investment wise, that are out there. And hopefully, hearing some of this will engage some thinking there and maybe create some opportunity for folks.
That's the hope.
Those are two great strategies. We've used the 1031 exchange personally on several occasions. We have a couple clients who we've referred to opportunity zone strategies. At the time, we didn't have an offering that we felt comfortable with. I think some of that's changing with some of our relationships with some of our sponsors now. So there's some opportunity there. But the 1031 has been, a no-brainer in a lot of respects for clients that want the income, they want to defer the tax, and by the way, they still get that stepped-up basis later too, which we would again tell you to talk to your tax person. But by not selling the asset in their lifetime, they collect the income, and at death they get that stepped-up basis, and they're still not paying tax. So now they're gone, but their kids aren't paying tax. Let's put it that way. So the great
Right, right.
strategies. Yeah.
Absolutely, absolutely, and we appreciate the honor and the reputation to be able to be approved on platforms such as you and your firm. Cantor has a very long-standing relationship in the investment management business. Cantor has been around since 1945. We've only had two people run the company in close to 80 years as of this year. Bernie Cantor, who started the firm, a gentleman named Howard Lutnick, took over the firm in the early 90s, and as of last week still ran the firm and is now the Secretary of Commerce in the Trump
Wow. Yeah.
administration. So we have done a lot of things in investment banking, in trading on the floor of the exchanges. We invented the electronic trading of US government securities. A lot of people will know us from the tragic events of 9/11, where we occupied the top 5 floors of the North Tower. Howard was dropping off his son that morning, went on to rebuild the company from the ground up. It's now over 12,000 employees, 150 offices worldwide in 22 countries. We maintain an investment grade balance sheet, and we're one of only 24 companies in the financial services business that can say that they are authorized to transact government securities directly with the Federal Reserve, or what's known as a primary dealer. So you
Yeah.
can imagine the level of corporate governance and compliance that we have to adhere to. And then coming out of the great financial crisis, we started buying commercial real estate companies out of bankruptcy. A big name here in the Southwest United States is Grubb and Ellis. We
Oh
purchased them
yeah.
out of bankruptcy. We went on to buy Smith and Mack out of Chicago, Cornish and Carey out of the San Francisco Bay Area. 28 acquisitions later, they were all rolled up under one entity now called Newmark. And Newmark is a wholly owned subsidiary of Cantor Fitzgerald. And that's the fourth largest commercial real estate company in America. So we started an asset management business as an extension of Cantor and Newmark 9 years ago. And now we have roughly $14 billion under management across various investment strategies, real estate, infrastructure, tax planning, as well as a full lineup of mutual fund, ETF, and separately managed account strategies. So really exciting.
What a comeback story. Yeah. I do remember. Yeah, I was in the business obviously back in the time of 2011, and yeah, I mean that was tragic, and to bring it all the way back, it just shows the character of the leadership there. Well, I think I'm going to wrap us up now. I think we definitely touched on some ground. I'm guessing this may generate some questions from folks. So if you do have questions, you can always call me 877-474-4350 KDI Wealth, or you can email me at kevin@kdiwealth.com. If you have questions, concerns, would want to connect with Steve for any reason, from the advisor side, if you happen to be an advisor watching this and want to connect, I can connect you to our folks over there too. And Steve, can't thank you enough for your time you took with us today. And I've got to say that um, I love the way that you present it in a way that folks can understand. And again, I think one of the best gifts we can give clients is to get rid of the jargon and make things understandable so they can make better choices.
Couldn't have said it better. I'm excited to be here. Thanks so much for having me. Appreciate the time, Kevin.
All right, you take care.
You as well. Bye now.
Bye bye.